And today's topic is like investing basics, building a disciplined investment strategy. And today we're gonna know some interesting things like sound investing and the best practices. So Johnson is going to share the fundamentals of sound investing practices with the flexibility to discuss more advanced topics that should arise. And we're gonna learn about the current market volatility, asset allocation, diversification, and the investing discipline. And I request Vijay Gaddam to give quick intro about the Matthew Johnson.
Um, hey Deepti, yeah. So I think we should just jump in the topic. So Matt and William, thank you so much for giving us, the opportunity for giving the information to the wealth and management information to our community. I appreciate you guys taking time. And I would like you guys to introduce and then probably kickstart this meeting. So the floor is yours, Matt and William. Please go ahead.
All right, thank you both. Good morning, everybody. Bill and I, like Deepthi and Vijay mentioned, we run a wealth management firm out of San Diego. We are focused on financial planning for the long term. And today we're going to go over a topic that has been coming up with our clients frequently, and is how to address in investing and the basics and what a lot of folks are running into as far as difficulties and things to overcome. So we'd like to share a couple of thoughts that we had, and hopefully it'll be helpful today. Bill, I'll let you introduce yourself.
Thanks, Matt. Yeah, Matt and I have been partnering together for the best part of 4 years now. Like you mentioned, we do a lot of work, with folks across the board in comprehensive financial planning. But again, today's topic is kind of the basics of investing, and there's going to the more it might seem kind of fundamental. I wanted to make this really kind of useful for everyone across the board, right? We wanted to make sure that our beginner investors who maybe are excited to start to see maybe the market do some of the heavy lifting for them, start to gain some confidence in ways to approach things, while also having some topics that might be really beneficial for your more seasoned investors, for those of you who have been kind of in this investing in this arena and might be looking for some of those things to kind of take your approach to kind of to the next level. So we're excited to share some ideas today. What I'd encourage you to do is, if questions are popping up in your head, drop them into the chat, and we'll write them down, and we'll be able to kind of address those things at the end.
Awesome. All right, with no further ado, let's jump in.
Can't help each other. I'll be like punch it to your mate. Can't do that. No catches and cakes out of maybe.
Can you please be on mute? Yeah. Thank you.
Hey, Vijay, can you enable sharing for us?
I think Vijay has a different appointment, maybe.
Oh, does he? Okay.
Matt, I made you the co-host, Matt. You should be able to start sharing now.
Okay, awesome. Thank you so much.
No problem.
Bill, are you able to see my screen?
Yes, I can. It's just not in the presentation mode. It's still the editing mode or view.
Let me make sure I'm sharing the correct screen here.
Okay.
Okay, Bill, are we good?
Looks good. Yeah.
Okay. Awesome. Okay. So we're going over investing basics today. So stock market is a very complex entity, like most folks know. There's a lot of information out there that's making it seem like all of it can leave your head spinning at times. And sometimes the market, it feels like it's flying high forever, only for it to suddenly drop and send everybody running for cover. Conventional wisdom tells us that what goes up must come down. But even if you think about market volatility as a normal occurrence, it can be tough to handle when it's your money that's at stake. So I'm glad we're all, here today, able to have a conversation. Our goal is to help you answer a question that's on the minds of many of our clients that we've been speaking with. How can I feel more confident in my investing strategy in today's changing world? So today we're going to help you get a handle on some of the fundamentals of investing, core strategies that even the largest institutional investors rely on to help them navigate the often choppy waters of investing. We're going to share with you 5 strategies that can help you view the markets and help you be more confident as an investor, regardless of market condition. So first, you'll see why a sound investment strategy starts with the end goals in mind. And then we'll explain why balancing risk and reward is an important part of investing. And then you'll learn the components of a balanced, diversified investment program. And then fourth, we'll talk about why discipline is crucial to the investment success. And then we'll learn how to build momentum on the investing strategy and the plan itself. So we believe we run our firm out of a company called Northwestern Mutual. Bill and I are broker and dealers, so we can use any company that we choose. But Northwestern Mutual's perspective is that expert guidance is invaluable when building your portfolio, and that asset allocation is a foundation of a diversified investment program. And we also believe in the value of investment fundamentals, the basic principles, such as getting an early start, investing regularly, and using strategies that help reduce the impact of market volatility. There will be a time at the end to answer questions, and for your reference, we're going to send out, let's see. Our goal was to send out a handout that has a lot of the terminology we'll go over for any of those folks that are joining who are new to the investing world. Bill, I hit reply all to Vijay for the handout. I wonder, maybe there's a way we could put it in the chat.
Let me see if I can do it.
Okay. Yeah, it's the PDF. I think it's investing or investor basics. Maybe we can put that in the chat for anyone who wants to take a look. All right, we'll keep going in the meantime. All right, so before we get too deep in investing strategy,
Can you please? Yeah.
Thank you. I want to talk a little bit about market declines because they're the main reason most people shy away from investing. So think back to recent times when the stock market plunged. We have 2022 in recent memory. It was the 5th worst trading year in the stock market's history since 1926. What did your gut tell you to do? Sell every stock or mutual fund that you own? Pull your money out of one investment and put it into something that looked like a better choice? Or was your instinct to wait it out and see what happened? If you felt a little panicked, you're probably not alone. Market dives are unnerving, to say the least. But here's the thing, market declines happen, and this is a look at how markets have performed over time. You can see that when you're looking at a single year return, it feels like there's a lot of dips and plunges. The market was positive 74% of the time, but down about 26% of the time. And 26% is scary when a lot of your money is at stake. But if you look at the results over a longer period, things start to look a little bit different. Over rolling 5-year periods, stock market returns have been positive about 87% of the time. That's 13% more often than when you're looking at individual years. And while holding on to stocks for the long term doesn't guarantee you won't lose money, over 15-year rolling periods, stocks have not had a single period of negative returns, which is very encouraging. So market declines are a given, but there's ways that we can mitigate their effects on the portfolio. The first step to a sound investing strategy is to figure out what goals are important to you. What are you trying to accomplish by investing your money? Some people are saving for retirement, some for their kids or their grandkids' college funds, and there's many reasons for investing as there are investors. But if you haven't decided what you want your investments to accomplish, it's going to be difficult to know what we need to do to get to your goals or even know when you've gotten there. So let's say you're dreaming about buying a vacation home or starting a family. If you just sit back and think about how great it would be if you had all had some place to go in the summer, what do you think your chances are of buying the property? But if you make a list of amenities, you need a property to have, research prices for properties in the area, look over your financials and figure out how much you need to save for a down payment, and also decide that you want to buy in a certain time period. The chances of success in reaching that goal are much, much greater because you're being specific, right? You thought exactly what you wanted, how long you have to get there, and how much you need to reach your goal. When you know all that, it makes it a lot easier to figure out what you need to do to be successful. So very simply, identifying goals brings your future into the present. Bill and I are in our practice, we're very focused on vision of our clients, and goal-oriented planning. Knowing where you're headed can carry you through the emotional ups and downs that come along with the stock market. So having kind of conviction around what's important for you and your family carry us through the turbulent times that we experience in the stock market. And that holds true, really no matter what you're planning for. And let's talk about a goal that most of us think about at some point in life: retirement. Most of us want to retire, but what that means is different to every person. Maybe you want to move to a different state or a different country. Some people want to spend more time with their families, focus on volunteer work, or use their free time to enjoy hobbies. All of those are very different pictures of retirement that require different funding to make them happen. So being specific about what you want your money to do for you is very important. And goals should always be measurable. You need to estimate how much your dream retirement will cost. For example, you might analyze your retirement plans and decide that $500,000 will cover it. Your goal also needs to have a time frame, because saving that $500,000 means one thing if you're planning to retire at 65, and it means something very, very different if we're trying to retire at age 55. We also want to figure out what resources you already have available. So for example, you might already have a 401k at work, a Roth IRA, or maybe a variable annuity. And after that, you can start to identify the specific steps you need to take to reach your goal. For example, you might decide to increase 401k contributions to 15% of your salary and put an additional $5,000 into your variable annuity account. We used retirement as an example, but having multiple investment goals is very common. It's also common for your goals to change over time as life evolves. And that's why it's important to revisit your planning on an annual basis or whenever you have a major life event, so that your investment plan grows with life. So there's no getting around the fact that markets can be risky. Investing is definitely a no pain, no gain type of endeavor. And it's why the second step to investing successfully is understanding risk. That means protecting yourself against risk when you can, and when risk is inevitable, as it is with investing, knowing how much volatility your stomach is capable of handling. So let's chat a second about risk management. Things like car accidents, house fires, floods, medical issues, disabilities, or the need for long-term care can throw a huge wrench into your financial plans. No matter how strong your investing strategy is, if you have to stop and use those invested funds for something that they weren't intended for, it's going to affect your ability to reach your intended goals. So for example, if you're injured and you didn't have medical insurance or enough money in your emergency fund, you might have to pull money from your 401k to pay for the unexpected hospital bill. And once you've recovered and you built the funds up to get back to where you were before the injury, if you've missed work because of that injury, you might also be missing out on income you rely on for your regular expenses. So protect yourself and your income, get insurance to cover risks, and to cover the risks you can, and build a solid emergency fund to help you get past any other bumps you run into along the way, and then combine that strong foundation of risk management in your investing strategy into one overarching financial plan. Protecting yourself against risk means that you can be more confident that an unexpected event or expense won't derail the investing strategy itself. Anytime you invest, there's risk involved. Nothing is a sure bet, but everyone's tolerance for risk is different, and that's okay. There's no right or wrong level of risk tolerance. And we usually, Bill and I use what we call an investor profile to identify our clients' tolerance and pain level for risk. So we think about factors like investment time frame, how long you'll be investing before your money is needed, when you're ready to start using those funds, and how long will you be making withdrawals. That's called your withdrawal time frame. We also look at how much of your money is already in safe things, very stable assets like permanent life insurance, pensions, savings accounts, fixed interest accounts. Those are considered stable assets. And there are other questions that we ask too. Figure out liquidity, income stability, and personally how you feel about the stock market. And how our clients answer those questions together helps us or helps you know your personal risk tolerance and what that means as far as investing. It also gives you confidence when you evaluate all of your options that are on the table. So knowing how much risk or volatility you want to accept is a big part of the picture. But it also helps to recognize that the returns look a lot less volatile when you view them over the long haul, the big picture. Because over the long term, periods of high returns tend to offset periods of low returns. So take a look at the chart. It shows the S&P 500 and how it's performed since 1950. If you look at each decade separately, there are a lot of dips, a lot of ups and downs. But in 70 years, the S&P 500 has ended the decade with a negative return only one time. And it was positive again in the following decade. The trend is for the market to increase. And you can see that even though the market does drop at times, staying invested over the long term helps reduce the risk of loss in the long run. So we talked about identifying goals. Let's go into diversification. So today, a lot of investors have a huge number of options to choose from. It's almost like if you're like me, it's analysis paralysis. Different assets and different investment vehicles, all available from hundreds of financial service providers. And where you invest your money depends on what you're trying to achieve, your risk tolerance, how long you're trying to invest, and what investment options are available. Diversification is splitting up your investments into different assets, so you're not putting all of your eggs in one basket. So to speak, finding the right combination of different investments to meet your goals is a way that suits your unique investing needs. Asset allocation is exactly what it sounds like. It's how you allocate your assets or split up the funds into different asset classes to create a diversified portfolio. It doesn't have to be complicated in order to work, but it should include at least 2 asset categories to be effective. That's because each asset category has something unique to contribute to the long-term investing plan. Equities, what we know as stocks, typically offer the greatest long-term growth potential, but they also have a higher level of risk. Fixed income securities have other benefits and detractors. Bonds are a good choice for income, while cash alternatives such as money markets provide liquidity and stability compared to other asset classes. Money market funds are designed to preserve the value of your investment at $1 per share, but unlike some other fixed income securities, they're not insured or guaranteed by FDIC, Federal Deposit Insurance Corporation, or any other government agency. It is possible to lose money by investing in them. So as your investment portfolio grows over time, you can consider broadening your asset allocation as well. So for example, the US stock market is composed of small, medium, and large companies, each of which can be further subdivided into growth or value categories. And the same is true for bonds and cash alternatives. They can be categorized by investment grade, maturity, sector, and tax status. It seems like the markets are going through a rough patch. There are always some people who lose a lot of money in confidence, and there are other ways, and there's others that sail through barely touched by market losses. So why is that? Why do we have people that go unscathed, people that come out beaten and bruised? It's not just that some investors are lucky or that they know some secret that gives them the edge. Those investors who do well understand diversification and asset allocation. So like I mentioned earlier, different asset classes have different benefits and drawbacks, and they tend to react differently to economic activity and market trends. So combining them can help provide investors a balance between risk or expected risk and returns. Sometimes stock returns are up while bond returns are down, and vice versa. When combined, these offsetting movements help to reduce overall portfolio risk. And the asset allocation models shown here represent possible combinations of stocks and bonds. Even though bonds are considered less risky than stocks, notice that even the most conservative risk portfolio has a mix of different assets. So diversification is key when investing. Even though there's a lot of clear advantages to diversification and asset allocation, many people's portfolios represent a hodgepodge of investments based on hot tips from friends, coworkers, or last year's top performing stocks, rather than a clearly defined goal. If there's one asset class that led the market every year, that might make sense. but the markets are ever changing. Making it impossible to predict which asset class will perform best or worst in any given year. So each color on the chart that we're looking at represents a different asset class. Quite simply, that's our Bill and I's vernacular for the areas of the market that we can put money into globally. So you might think that there's a lot of there's some things that look really good. You know, that's the bright red, which represents international emerging markets, and that's at the top. What, four different times between 2007 and 2021. But look at where it shows up in the other years. It was at the bottom in 2008, 2011, 2018, and 2021. And it was the second best in 2020, but the second worst in 2013 and 2015. So based on all the movement, as you look across the chart, how can anyone really know what the next year's winner is going to be? When asset classes move in and out of favor this quickly, it's trying to shift your money around so you're only investing in the top performers rarely works. The better approach is that diversified portfolio we've been talking about, which is shown in the white tile of the graph. The white tile. That's because in the white tile, we're not relying on any one asset class to do the heavy lifting. So, of course, you know, diversifying your portfolio means that all of your investments won't be the best performer in any given year, but it also means that they won't all be the worst ones either. So by developing a balanced investing program, you can reduce the volatility associated with the ever-changing market. So this is a very challenging step, the next one that Bill and I run into when discussing investing with our clients, and that's remaining disciplined. For those of you that go to the gym and work out and exercise, if you're like me, sometimes I want instant results. Sometimes I want that six-pack after going to the gym for a week. Right, but I have to remind myself it's days that compile over and over and over, and then if I go every week, after a few weeks, then I start to develop the six-pack, hopefully, and it's a matter of discipline versus a get fit quick. So we talked about how timing the market isn't a great strategy, but it's not surprising that investors still make emotional choices, jumping in and out of investments in hope of getting the best returns. And no one wants to lose money even in the short term. But take a look at this. The chart shows how missing the best trading days in the stock market over a 20-year period affects your returns. Being invested that whole time gives you a 9.49% return, which is not bad. But if you try to time the market and you end up missing out on the 10 best trading days in those years, that return drops below 2. If you miss out on 20 or more of the best trading days, the portfolio will lose money. And since large ups and down days tend to be clustered together, by trying to avoid the market dips, you could easily miss out on the best days as well. And that can have a big impact on the portfolio in the long run. So when you start to see the market shifting and you get nervous about your investments, it takes discipline, sometimes a lot of discipline, to resist the temptation to try and void the bad times, the pain. It takes discipline to sit back and trust that over time, the portfolio, the diversified plan will do the work it was designed to do. So compounding, that's, I think Einstein said, compounding is the eighth wonder of the world. It's when your assets, earnings, are reinvested into your portfolio, which means you're earning interest on top of interest, and it can make a big difference over time. The graph that we're looking at, it shows how much you need to invest each month in order to have $1 million by age 65. Age 65 traditionally in the US is like normal retirement age. And so we're assuming a 7% interest rate compounded annually. And it's important to note that the numbers don't include any taxes or transaction costs, fees. But if you start investing when you're 25, you'd only need to invest about $400 a month, $381, to get to $1 million by age 65. That's a total out-of-pocket investment of $182,900. If you waited just 10 more years and started investing at age 35, you need to more than double the monthly contribution to get to the same $1 million by age 65. You need $820 per month, which is a total investment of $295,000. Starting at age 45 means you need to contribute almost $1,900 a month, and if you waited to start at age 55 with only 10 years to invest, you'd have to put almost $6,000 in a month, a total contribution of $693,000, which is a lot of money. So why is there such a difference? Starting earlier allows interest to compound over time. The more time you give compounding to work its magic, the bigger the difference. And it's important to note that these numbers don't include taxes or transaction costs, since stocks can be more volatile than other types of assets. Returns and principal invested in stocks are not guaranteed. So the fifth step is simple. It's momentum. So going back to the gym example, let me ask you guys, how many of you exercise? It's a struggle for me to get to the gym weekly, but what I've found is, as much as I hate to suit up and get out there, I always feel better when I do it. And the more I exercise, the more energy I seem to have. And the more energy I have, the more likely I am to keep going to the gym, right? So reinvesting your investment earnings is crucial to the compounding that we just talked about. It creates the same type of momentum that I get when I go to the gym. It's because we allow your dividends to compound over time. Your investment earnings are building more investment earnings. So income producing investments are key to this approach. They can help your investment plan. They can help keep your investment plan on track even during the market declines. And why is that? Historically, many companies have kept paying dividends at the same rate, no matter what the market is doing. Bonds and money market funds also provide a steady stream of interest payments, which can help cushion your portfolio during periods of volatility. Reinvesting income is a key component to boosting returns. So this chart compares the hypothetical growth of $1,000 invested in stocks and bonds over a 20-year period, with and without reinvestment. Reinvesting allows you to capitalize on compounding, which means you earn income on the principal investment in addition to the reinvested dividends in coupon payments. If you compare the stocks with reinvestments to the stocks without reinvestments, you can see that the returns on the $1,000 are about 2% higher if you reinvest. With a $1,000 investment in bonds, it's 2.6% higher if you reinvest. So whether it's stocks or bonds, reinvesting that income can help maximize growth in the portfolio over time. Keep in mind that total return represents capital appreciation, income, and reinvestment income. And as mentioned earlier, government bonds are guaranteed by the United States government, while stocks are guaranteed and have more volatility than bonds. So those 5 investing basics can help you stay on track despite market ups and downs. And I know we've covered a lot so far, so let's take one more look at each of the steps. Step 1, start with goals, write them down, and be specific. Quantify as much as possible, so you know exactly what you're working towards. Step 2, protect yourself against risk when you can, and know yourself as an investor. Understand the role that risk plays in helping your investment strategy. Step 3, build a balanced, diversified strategy, one that can help smooth out the bumps when it comes to investing in the market. The 4th step, give your investment plan time to work. Stay strong in the face of volatility and trust your diversified plan. And last, let the momentum build. Strategies like compounding and reinvestments can help you speed your way to the end goal. Bill and I, when we work with our clients, we find that there's a lot of information out there. There's a lot of murkiness. There's a lot of noise in the media about the markets. Even when you feel comfortable with the basics of investing, it takes time to make sense of everything. And it's difficult to be sure you're making the right choices to be successful. And that's why it can help to work with some professional, someone's whose job it is to know all of these concepts that we've talked about. You want someone who can help you wade through all the information that's out there and create a sound investing program to grow and manage wealth and incorporate that into a strong financial plan that helps you protect what you care about most, and someone who is committed to providing you with continuing support and help you stay on track toward your goals as life changes, as life evolves, and put markets into perspective so that you can maintain focus during all the turmoil that happens. So it's important, make sure you trust the representative that you work with, the investing professional. Make sure it's with a reputable company that's been around for a while. We run our practice through Northwestern Mutual, and we're ranked in the top 10 independent broker dealers by leading investment industry publications. And we've been helping clients achieve financial security for over 160 years, close to 170. And we've gotten the highest financial strength ratings of any life insurance company from all 4 major credit rating agencies, and our wealth management retail investment clients' assets are over 200 billion, which says a lot about our dedication and always doing what's best for the folks that we work with. So I want to say thank you again for allowing us to chat today. Vijay, thank you for inviting us. Really appreciate the opportunity. I hope that today was the discussion allowed you to understand the basics of investing and what motivates you to start thinking about how investing can help you reach your goals. And our mission is, Bill and I, our mission when we meet with clients is to help you alleviate the anxiety that comes by not having a strong financial plan. So any questions, certainly happy to answer. And if there's anything really specific, certainly happy to jump on another call and talk to you individually.
Sure. Thank you, Matt. Thank you. Thanks for your time. And we have few questions from the audience. So
We do, Matt. We've got a few questions here that came through over time. The first is, what is the best way to invest in a 401k? Is it to utilize a Roth or pre-tax?
Okay, great question. Great question. My favorite answer is it depends. Okay. So it depends on your situation. I think traditionally most folks have looked at, do I do traditional, do I do Roth based on retirement? Retirement, am I going to be spending more than I'm earning now? But the other consideration is what your perspective is on future taxes. Okay, we're staring down the barrel of a $34 trillion deficit with a considerable amount of unpaid liabilities through Social Security and Medicare. So a lot of our clients, when we speak with them, they see that the deficit is high in that we have very low income taxes, with historically income taxes being much higher. In the 60s, the highest bracket was 90%. 90%. It's 37% now. So some folks say, hey, I'm not willing to make that bet that taxes are going to be lower in the future, and they use the Roth account. Okay. If you feel that in retirement you will be spending much less than what you're earning now, then the traditional 401k might be the better option. So long way to say, it depends on your situation. It depends on the other assets in the portfolio, what you have to manage your tax bracket in retirement. Hopefully that helps.
Matt, I don't know if you have this chat up on the side, but the next question is, the market timing slide is real. How do they determine the best trading days?
Well, we don't. Bill and I, our philosophy when we're working with folks and investing is to remain invested for the long term so that you capture all the best trading days. Like that slide mentioned, The worst days and the best days are usually clustered right next to each other. They're usually side by side. So timing, trying to get in and out of the market, usually will not serve you well. It won't serve you well over the long haul. So just remaining invested, not trying to figure out what the best days are, will bode well in the long haul. Does that answer the question, Bill? As far as I'm not
Yeah,
seeing.
I think so. I think when we're talking about the slide too, the best trading days are like if you're asking about how it's been determined historically, right? It's just a look back, right? It's a look back to, you know, which days were the best, which days did the market or specific indexes or you know, collectively markets as a whole kind of rise and you know, the rising tide lifts all ships type of thing. But the entirety of the market is up, right? So if we're asking how we determine that historically, it's just really a look back to see what the best performing days were.
Yeah, there's certainly lead indicators that help us foresee what trends in the market could happen. But no one has the cheat code. No one has the cheat code or the crystal ball to what is going to happen in the market. There was one person that had the cheat code, Bernie Madoff, who is now dead. He knew the cheat code because he cheated, but you know, insider trading. But if we're doing this the right way, it's very, very difficult, even for the CFAs, the certified financial analysts, and the stock traders to beat the market. That is an incredibly, incredibly difficult task. Okay, even the best traders in the world have struggled to beat the market. So just remaining invested through the ups and the downs. It's called dollar cost averaging, DCA, dollar cost averaging, where you just systematically fund your accounts methodically. And that way you capture all the ups and the downs, and you're not trying to buy at the dip. Most people, when they buy at the dip, they miss the dip. They miss it. So systematic funding, DCA, dollar cost averaging, is helpful. What other questions do we have?
Was a question here from Deepthi on following volatility vehicles like VIXY or VIX, and what are just some other ways to determine volatility?
Other ways to determine volatility. Deepthi, can you?
Yeah, this question is.
Yeah. Hi, Matt. I asked a question. My name is Shrikant Amigala. So volatility, you know, in the morning in the news, they cover certain indexes and all, like saying that so and so is the performance of Nasdaq, so and so is the performance of this one. But if VIXY is more than $24 or more than $26, you don't see IPOs getting opened up in that particular week or in that particular month or something like that. Is there any other things like to determine that other than VXA or anything? Not really straight, I guess, but
yeah, I'm not sure. Not sure.
Yeah, the volatility kind of futures that we're looking at there, right? They're imperfect, right? Like it's like anything, right? We're trying to predict what something's going to look like, right? And you know, some period of time down the road. Like where Matt says we're unsure on that. Look, there's kind of your standard volatility that happens, right? Just through market conditions, right? When the market is, you know, a certain amount overvalued, that type of thing. And that's where something like, you know, VIXY is going to give you a decent, you know, predictor maybe, right? Some leading indicators. The trouble with that is Some of the biggest market movements that we see,
Yeah.
right, are the result of outside catalysts, right? We don't know when a war is going to break out in the Middle East, right? We don't know when, you know, there's going to be a catastrophic earthquake that decimates a country, right? We just don't know those things. So as much as those kind of volatility, you know, predictors are decent, right, when it comes to reading kind of market you know, market trends and where we are as it relates to, you know, our companies in general overvalued and these types of things. Yeah, they can be useful, right? But the reality of it is our biggest market movements oftentimes are not even tied to those things, right? They're tied to political events or, you know, weather events, right? We don't know when half of Hawaii is going to burn down. You know what I mean? Like, so it's like they're good. It's helpful on your kind of day to day. But again, I think it rolls back to the core concept that Matt's talking about, and that's really kind of staying kind of invested with strong fundamentals as they tie to your goals, right? Like getting into a portfolio that has a level of risk that you're comfortable with, right, to achieve the things that you want to, and then just staying steady. Trying to time the market is so challenging, right? It's just a really, really difficult thing to do. So, you know, our philosophy usually is let's set a goal. Let's kind of get ourselves invested driving towards that goal. And we know, yeah, there'll be ups and downs, right? But you know, over the long haul and in the time horizon that we have, you know, we should, given the historical performance of markets, get to where we want to be.
Okay. Thank you.
Yeah, thank you, Bill. Let's just answer. Let's make sure we get through. There's a couple other really good questions that may apply to some folks. Deepti mentioned, hey, can you cover briefly cover RSUs, restricted stock options?
Okay.
So Bill and I, we work very, very heavily in the tech world. A lot of folks at, you know, Apple, Google, ServiceNow, Oracle, Microsoft. A lot of these big tech companies will do compensation less through salary and more through these thing called RSUs, restricted stock units. Deepti, the way you can think about these is simply as a cash bonus. That's all it is. That's all it is. Okay. Stock options are totally different. Okay. Netflix, they pay a lot of their software programmers and tech folks in stock options. Okay. That is more complicated. RSUs are simply a cash bonus. Back in the day, what companies used to do is they would pay you a salary and then they would cash flow you a bonus. Okay. Yeah. They don't do that anymore because it's very difficult for them to manage cash flow in today's world. So what they do is they do RSUs. Okay. Restricted stock units. So you get grants, you get batches of grants, and then they vest over time. Okay. So basically you're just given stock in the company as a bonus. Just think of it as a cash bonus. That's how you should treat it. It's not a stock option where you're trying to figure out, hey, my taxes that I'm going to realize, timing of the stock price. Don't think of it that way. RSUs, when they vest, most people, you just sell them and take it as income.
Okay. So
Okay.
you suggest basically taking whatever they give you or maybe negotiate something better, and then when they go public or when they are going to be sold out, you just take it, or when they're being vested, you just sell at that point or something.
Yes, if you're talking about pre-IPO, if it's a pre-IPO, there's it might be like stock options. Do you have RSUs like pre-IPO?
No, this is example of the Snowflake, the Databricks, and companies like that.
Yeah. So that's a little more complicated. What Deepthi had asked was, just what are RSUs and like how to treat them.
Yeah.
Right, Deepthi?
Yes, Matt.
Okay. Did I answer your question? Is that helpful?
Yeah, you're perfect. Yeah.
Okay. All right. Good. All right. Okay. But yeah, as far as like pre-IPO, right, where they're granting you stock or equity in the company, there's a couple ways to deal with those. You can there's the secondary market. You can sell them pre-IPO and just take them as cash. You can get cash for them. Okay, so we've done that with clients before, but it's a more calculated decision than the RSU decision. There's more on the table as far as, hey, what do we think the company is going to do IPO? Should we get out now? Should we wait and see if they 10x and then we have like private jet kind of money?
Yeah.
So there's a little more of a calculation and research based on that decision.
I can reach out to you guys when I need such information.
Yep. What are the assets which we can buy to have great returns? I think this goes back to risk tolerance, how much volatility you're comfortable with. There's certainly asset classes that outperform others. Like most of us have a recent memory, right? We've watched the tech market. We watched tech companies the last 10 years. They've done very, very well. So those are more sectors. I don't know assets. Bill and I, we don't favor any one area. We believe in having a little bit of everything that manages the ups and the downs of the market. So we want to manage the peaks and the valleys. There's certainly asset classes that have performed better in the recent decades than others, but they usually come with a lot of volatility, a lot of ups and downs. So I wouldn't say there's a certain asset that's better than the other. They just serve different purposes. Other question was, is there a minimum amount required to be a client? No. So our practice is we are not like the big firms in this space, like the Morgan Stanleys, the Fidelities, the Merrill Lynches, UBSs of the world. My parents were school teachers. I grew up in rural Pennsylvania, in Amish country. My parents talked to me about money, but not really in detail. And I didn't know all the ins and the outs of investing and wealth building. And once I was exposed to this information, I felt that everyone deserves to have this conversation, no matter where they're at as far as income or assets. Like we went over in the slideshow, there's a lot of murkiness out there. There's a lot of misinformation. It's very difficult to sift through all of those wavelengths. So Bill and I, we do not have minimums. We want people to feel empowered about their finances and help their families and themselves. We do not have minimums like the Morgan Stanleys of the world. What our goal is really work with good people. I think that's our criteria. It's not about income or assets. It's more about, do you want to do the right thing for you and your family? And if the answer is yes, then we're open to a conversation. So no minimums. Any other questions from folks out there?
Like most of the people wants to learn discipline and some basics. So can you suggest any handbooks on the learning?
I'm sorry, Deepthi, I got feedback. Can you ask it one more time?
Like most of the people wants to learn the discipline and some basics about the wealth. So can you suggest some good books for the
Good books.
Yeah.
Good books. Ooh. Put me on the spot with that one. Yes. Let me think about it. The book I'm reading right now, maybe I can give that. The book I'm reading right now is called The Power of Zero. The Power of Zero. It's on my desk. It's not about necessarily investing specifically. It's about managing your tax bracket in retirement. It's very interesting. Very, very interesting. A lot of really good information. It's a short read. It's a short read in the writer. He makes it simple. Okay, very, very complex stuff. And he distills it down in very simplistic terms. I'd recommend that one, but that's not Deepthi. That's not like investor basics. But for a lot of folks we work with, they earn a very good income. Very good income. They have RSUs, they have base salary, they have bonuses, they have real estate, right? Managing tax brackets is very important. And in that book, like I said, it simplifies a lot of complex situations. So that's one I can think of off the cuff. Bill and I'll put some thought into it. Maybe we can do a reply all with a couple good reads once I can think about it.
Yeah, that makes sense. Sounds good.
Okay.
So we have a question from Satish. Like, what do you think about IUL investments?
Yeah. Satish, can I ask, where's that, where'd you hear about it, or what information do you know about it?
Yeah, the friends and basically they are talking about these tax brackets at the retirement, right? How we can save the taxes, because we have income, but if we're paying a lot of taxes, that's going to be hurting our income, right?
Yep.
So
Yep.
the companies we hear, a lot of people doing these investments, insurance agents, to speak,
Yep.
like there are a company called HGI. They're trying to get a lot of these people into that. I don't know. We can say it's a lot of people say it's a scheme, a Ponzi scheme. Some people say no, it's not. There's a lot of misinformation on the internet, and
Yep.
no clear guidance. So that's causing a lot of people headache.
Yeah. Yes. We are included in that. So, yeah, great, Satish. Great question. Okay, we are seeing this question come up often with our clients. Hey, should I do this thing I'm seeing on social media, this IUL idea? What an IUL is, it stands for Indexed Universal Life Insurance. So it's a life insurance policy that gives you exposure to the stock market. Okay, this is very, very complicated strategy. Very complicated. Okay, the umbrella term is permanent life insurance. Okay, an IUL, an Indexed Universal Life Insurance policy, is one iteration of permanent life insurance. There's many forms of it. Okay, there's whole life, there's variable life insurance, there's universal life insurance, there's Index Universal Life Insurance, there's survivorship, there's many forms of it. An IUL is a hot topic right now because of the way that it is being sold. It is being sold under the guise of you get market exposure, you get upside potential, but you get downside protection. So you can partake in market growth, but if the market tanks, the insurance company says they'll protect you from losses. So there's a floor. That's how they're being sold. Okay, when you look underneath the hood of the construction of those contracts, they are less than favorable. It's very complex, but you don't have direct exposure to the stock market usually. Usually they are investing in stock options trading, very complex. Most folks don't understand how that works. And it's difficult for those contracts to produce the rate of return that they usually promise. I joke about it, but I think about those specific forms of permanent life insurance, the IULs. I think of it as a, you know, the car in El Camino. It's like part car, part truck, like smashed together. You know, it does two jobs at once, but it doesn't do one job really, really well. That's how I think about those IUL things. That said, the permanent life insurance strategy can be very, very compelling, but it has to be structured the right way. It has to be structured the right way, and you have to do it with the right company. Okay, because they are not all created equal. So Satish, hopefully that's some feedback. Hopefully that helps answer that question. Certainly
Yeah.
happy to have a side conversation if you want to take a deeper dive, because it is, like I said, very, very broad topic and very, very deep.
Right. Thanks for that, answer, but you can probably, have a separate session on that specific.
Yeah.
The reason I'm asking, the people who are getting into this kind of, they are pulled into this. I want them to get more clear understanding when they get into this, A
Yeah.
lot of people don't know the complexity inside, like you said, the way it structures.
Yeah.
So there are a lot of people, especially, they think we are getting a lot of money at the end, like 65, it's a tax-free money or something. If it is not structured, that you may lose a lot of money,
Yeah.
your original investment.
Yeah.
So
Yeah.
it will be great if you can please, have a, some another session separately complete on that IULs. That'll be really helpful for a lot of people,
Yeah, happy to do it. Happy to do it. Yeah, because yes, we see these things all the time. They come across our desk on a weekly basis, and most of them will implode. And like my business partner, his name is Robert. His mom had one of those IUL policies, and she didn't fund it correctly. Okay, so the way it was sold to her is like, hey, you only need to put in $100 a month or something, right? But really, what it needed was like $200 a month. So she got a phone call from the company 30 years into the policy asking, hey, this thing is going to blow up. You need to dump in $10,000, or it's going to surrender.
Okay.
So it's very, very unfortunate. So yes, it's very complicated. It has to be done the right way. And there's usually, from our perspective, Bill and I, we usually steer away from those IULs, and we use other forms of that permanent life insurance. Permanent life insurance can be a very, very compelling asset, but it has to be done the right way.
Thank you. Yeah.
Yep. Thank you,
Hey,
Satish.
Matt,
Yes.
and Will. I just wanted to add one perspective. Is this is for everyone else, right? I personally work with Matt and Will. They have helped me a lot and I learned a lot from them for the last 4 years. My friends have been working with them for more than 4 or 5 years. They're very knowledgeable. So I don't know if you guys have shared your contact. Like, do share your contact so that people can, talk more offline on their specific scenarios, which could be very unique also. And that will give them the opportunity also to talk to you guys and more in detail for their specific, individuals. I would like you guys to make sure that, share that contacts and, just so you have that, just so the people have that information.
You bet.
Yeah.
Yeah, I'm putting it in the chat now, and we can send out a more formal email for everyone, and you're welcome to reach out if you'd like to chat about, whatever's on your mind. Yeah, we're happy to do it.
Yeah, thank you, Matt. And
Of course.
question, like, not to make you give an actual pinpoint answer, but out of curiosity, I have one question. If I
Sure.
want guaranteed return even in volatile market, so are bonds a better choice than SPI or S&P based mutual funds?
So the question, Deepthi, make sure I heard you correctly. Are bonds better than like SPY?
Yes, or S&P based mutual funds.
Okay. Remember my favorite answer? It depends. So no, I wouldn't say they're better or worse. They are very different. So bonds, right? Bonds and stocks have an inverse relationship. Bonds represent loaning money to a company, and stocks represent ownership of a company. Okay. So stocks are more growth oriented. We're really seeking appreciation over time. And bonds represent buying debt of a company. Okay, you loan them money and they pay you back with interest, plus interest. So they're just very, very different. And I wouldn't say that bonds are better than stocks. I wouldn't say stocks are better than bonds. They just serve a different role in the portfolio. They have a different job description. Bonds traditionally have been used for the safety component. They help create buoyancy in the portfolio when stocks aren't performing well, but they're not infallible. Okay, if you look at the bond market in 2022, right? 2022 is a great example. Very recent memory. Unique market happened. Okay, the stocks dropped. They were, I think, negative around like 24%, something like that. The bond market also bottomed out. It was a very, very challenging year for folks. The bond market was down, like the aggregate return of the bond market was down like 14%. So I wouldn't say that bonds are better than SPY, or which is the S&P 500. It's just different. It's just a different asset class, and it serves a different role. Hopefully that helps, Deepthi. I know it wasn't a direct answer, but hopefully that helps.
Yeah, before the 2022, the bond market in 2008, 2010, or 2000 until 2012, I think the bond market was like near 10% growth, whereas in the 2022 it tanked. And later, I think they've made some news on that. So like you said, yeah, when the whole it adds the buoyancy to your portfolio, and maybe if I want to diversify and not just focus on stocks, maybe put something in bonds also, so I have some parking lot safety kind of thing.
Yeah, and there's many different. If you remember that the chart that had all the different color tiles on it.
Yep, I saw that.
Okay, so that was just 9 asset classes, right? If you zoom in on the bond market, there's a whole nother chart. There's a bunch of different types of bonds and fixed income we can invest in, and each of them perform differently. Okay, there's ones that perform better, some perform worse. So there's very nuanced strategies that you can use in the bond market itself. And we stay very high level today as far as strategies to approach the market. But we can definitely get granular.
Yeah.
In the bond strategies as well. Yeah.
It answers my question. No issues. I was just concerned, when like Satish had this scenario where people were asking about IUL and a lot of misguidance and everything. Same thing for bond market too. Like when I was like thinking about it, hey, why you did not invest in Bitcoin? Why you did not invest in bonds? These kinds of scenarios. And I know what I did. I had some due diligence done before, but I wasn't ready to invest. So yeah. Thank you.
Yeah, of course. What else? What other questions are out there?
We can take these questions offline, maybe, Matt. I know we are running out of time, and yeah, let me give the vote of thanks for this session.
Okay.
Yeah. Wow, it's a knowledgeable and interactive session overall, Matt. So we would like to thank Matt Johnson and William Donovan for accepting this webinar request. And we learned so many new concepts today, like goal setting, risk and reward, diversification, discipline, momentum, and focusing on the core values. Like all these things we learned today. Thank you so much, Matt. And thank you for your expert guidance, asset allocation, investing fundamentals. I know this it's a very interesting topic and important too. So you mentioned about be specific to your goals, identify the goals, brings your future into the present, and setting the goals with the resources defined and the time frame. So yeah, good to learn about these things today. And one good thing from Matt is like he gives back to the society through his sharing knowledge on the wealth. So his goal is to educate the people in risk and rewards topic. So I would like to thank our international coordinator Vijay Gadam for introducing Matt Johnson and William to the NAPA. And we blessed us NAPA to have here and get this great platform given by our North American Padmashali Association. And such a knowledgeable and interactive session that we have today, Matt and William. So we'll reach out to you offline if our audience has any questions. They'll come up with, and we'll reach out to you offline. And special thanks to our executive committee, board of directors, chapter directors, RVPs, and RCs from different chapters, and not to forget our attendees, our friends and families who made this webinar a successful one. Thank you once again. Stay happy, stay healthy.
Thank you,
All right.
everyone.
Thanks, everybody.
Thanks, Vijay.
Thanks, Sujay.